Comparing corporate bonds to treasury bonds. How does investing in corporate bonds compare to investing in treasury bonds? As you might expect, corporate bonds carry higher yields than treasury bonds of comparable maturity. Why? Well, by now you're getting used to thinking that if a fixed income security seems to be promising a higher yield, it must also carry some higher risk. Clearly, one major risk you know about is default risk. If market prices start reflecting higher discount rates, that is, if the yields on corporate bonds rise, one potential explanation is that default risk has risen. Corporate bonds can be broadly divided into investment grade and speculative grade according to their risk as perceived by rating agencies such as Moody's, S&P, and Fitch. You can think of the investment grade firms as companies without much debt on their balance sheet who are very unlikely to default, like Solid Corp, and speculative grade firms as companies with a lot of debt on their balance sheets that are much riskier, like Flimsy Corp. Their debt is sometimes called junk bonds, or more euphemistically, high yield. Consider the history of defaults on these two categories of corporate bonds. History shows that investment-grade corporates are quite safe, but still not default-free, particularly in the worst recessions. As for speculative-grade bonds, in expansions, they too have a pretty low probability of default, perhaps a couple percentage points per year. But in recessions, the default rates on speculative-grade bonds really spikes up. In the past few recessions, they have risen to over 10% per year during the downturns. When a firm defaults, that does not mean that creditors necessarily experience a 100% loss. They might, but on the other hand, they might only experience the partial loss of a coupon payment or two, depending on where their rights fall relative to other creditors. Focusing on 1982 to 2012, for which we have good data on the loss rates, it becomes clear that the actual loss rates, or percentage of principal lost, are less than 100%. So for example, in 2009, over 13% of speculative-grade debt went into some kind of default, but only 8% of actual bond value was lost, because creditors did recover something in the legal bankruptcy proceedings. How much you recover also depends on the type of bond you have. A firm's capital structure might consist of first and second lien bank loans, as well as senior secured bonds, senior unsecured bonds, senior subordinated bonds, and junior subordinated bonds. Firms that have issued bonds that are secured have pledged collateral against those bonds, and there typically the recovery rates are very high. The designation subordinated means that the holders of those bonds will be in line behind at least some other creditors in a bankruptcy. And if you own junior subordinated bonds, then you're likely last in line among creditors, although at least you will be ahead of equity owners, or shareholders, who are mostly wiped out in a typical bankruptcy. Corporate bond yields depend on the factors that influence treasury bond pricing, as well as the default risk, and some other factors that we will discuss. So corporate bond prices are more volatile than those of treasury bonds. On the Wall Street Journal webpage, you can see big movers in corporate credit in both the investment grade and high yield, or speculative grade or junk bond categories. The difference between a corporate bond yield and treasury yield of comparable duration is called a bond spread. If a company's bond yield falls to be closer to treasuries, we say that the spreads have tightened. That means the company's bonds have become more valuable relative to treasuries. If a company's bond yield rises to be farther above treasuries, we say that the spreads have widened. That means the company's bonds have become less valuable relative to treasuries. It is often the case that companies whose bond spreads tighten the most are also seeing abnormally positive returns on their stock, and companies whose bond spreads widen the most are seeing abnormally negative returns on their stock. This is because the market is in essence revaluing the company's assets, and as you now know, debt and equity are both claims on those same assets. The other difference between U.S. government debt and other types of bonds is that U.S. government debt is extremely liquid. There are many different definitions of liquidity. One is related to the depth of the market. If you wanted to sell or buy a large quantity of these assets, how much would placing that order move the price? If not very much, then the market is seen as very liquid. Another measure of liquidity is how quickly you could execute a big transaction. So how much additional yield can one get by investing in corporate bonds over treasury bonds? When asking that question, you have to, of course, keep in mind that corporate bonds are risky and they might default. Here are some historical credit spreads. Again, these are the yield differences between corporate bonds and treasury bonds. First, consider the changes over time in the spreads of AAA bonds over 10-year treasuries. These are the highest quality bonds. And also the changes over time in the spreads of what Moody's calls BAA bonds over 10-year treasuries. The other large rating agency would call these BBB bonds. These are not junk bonds, but they are the lowest investment grade bonds. One thing to notice is that the spreads tend to be the highest during recessions, particularly the most recent recession, but also 2002 and 1982 to 1983. The exact drivers of these spreads is still a topic of active research, but perhaps the most obvious explanation is that companies are more likely to default during recessions when treasuries are especially safe. But there's still an awful lot of movement in the spread of AAA corporates to treasuries. These are very safe bonds, so it's a bit puzzling. And by the way, despite the bad reputation that AAA ratings on mortgage-backed securities received in the financial crisis, the ratings of corporations are generally considered a more straightforward endeavor. So what is going on here? Why are the AAA spreads moving around so much? Well, much of the spread between AAA bonds and the 10-year Treasury is probably not due to default risk, but rather other factors such as liquidity. And changes in the spread may be due to the market's demand for liquidity, which gets very high in recessions and volatile environments. There are also differences in state-level tax treatments of treasuries and corporate bonds that play a role in the AAA to Treasury spread. Now, BAA bonds, the lowest grade investment grade bonds, are more risky, particularly in recessions. In bad years for corporate debt, like 2002 and 2009, around 10% of the total outstanding debt rated below BAA went into default, with investors realizing substantial losses. So we can also look at the spread between BAA, somewhat risky, and AAA, safe corporate bonds. Since the 1980s, excluding the financial crisis, the BAA AAA spread has been relatively stable in the 0.5% to 1.5% range, though it is generally higher in recessions. Keep in mind that in order to realize these yield differences as investments, you actually have to hold the bond to maturity, be able to reinvest the coupons at that yield, and have the bond not default. Compare that to investing in a treasury bond. To realize the yield to maturity on a treasury bond, you just have to hold the bond to maturity and be able to reinvest the coupons at the yield to maturity. To realize the yield to maturity on a corporate bond, you have to be able to do those things and not experience a default. This raises the point that in talking about corporate bonds, there's a very important distinction between two concepts: the yield to maturity on the bond and the expected return on the bond. Because corporate bonds can default, the expected return on the bond, or the mean return over the different states of the world, is actually lower than the yield to maturity. To take an example, consider a zero-coupon corporate bond with the following features. It matures in 1 year, it has a yield to maturity of 8%, and it has a 10% probability of default, in which case you will only recover 60% of your investment in bankruptcy court. The distribution of outcomes then looks like this. There is a 10% chance that you'll lose 40% of your money, and there's a 90% chance that you'll get an 8% positive return. In this case, the expected return is 90% times 8% plus 10% times minus 40% equals 3.2%, which is far less than the yield to maturity of 8%. This is another example of how, when dealing with risky securities, you really have to think in terms of probability distributions and states of the world. The term expected return refers to the mean outcome. And of course, the mean outcome is not ever actually realized here, which is a problem with thinking in terms of expected returns instead of probability distributions. It's more useful here to talk about points in the distribution. For example, the median outcome, or median return here, is 8%. The median is actually greater than the mean or expected return here. That's something that's generally not true for the stock market. Usually it's less. The 20th, 30th, 40th, 50th, 60th, 70th, 80th, 90th, 99th percentile outcomes are also all 8%. There is in fact a 90% chance that you'll get an 8% return. But the 10th percentile outcome is that you will lose 40% of your money. A final caveat has to do with compounding default probabilities. It may seem that a bond which you estimate has a, say, 3% annual default probability does not carry much risk. 3% per year is not far from the historical annualized default probability of junk bonds, averaging over both good and bad periods. But over 10 years, the compounded default probability of such a bond would be around 26%. The compounded default probability is 1 minus the probability that it defaults sometime over that 10 years. So we have 1 minus 3% to the power of 10, or 26%. So it's important to take that cumulative nature of default probabilities into account. So how does investing in corporate bonds compare to investing in treasuries? Well, when you invest in corporate bonds, you take on the regular risks of investing in treasury bonds, but you also take on default risk. And unlike Treasury bonds, corporate bonds are not guaranteed to return their face value when they mature. So even if you hold corporate bonds to maturity, you have much more to worry about than simply inflation risk. You also have to worry about default risk. The yield to maturity on a corporate bond cannot be thought of as the expected return on the bond due to the fact that there are states of the world where the bond might default. But because these bonds tend to have very bimodal outcomes, bimodal means there are two of them, either the bond defaults or it doesn't, it makes the most sense when dealing with corporate bonds to consider the distribution of possible outcomes. If the bond matures, you get the yield to maturity. If it doesn't, you lose your principal up to whatever can be recovered on your behalf in a bankruptcy proceeding.